Eric, it's great to have you back on the show. Let's start right there. Why are you so downbeat on stocks here at these levels?
Thanks for having me. So we think that the risk reward here for equities is quite poor. As far as the economy goes, the real question is, so we're going to slow, we're going to have slowing growth, and we're going to have rising inflation. And the real question is, how much are we going to slow, and are we going to go negative? So that backdrop right there makes it such that our best case scenario, we think, for the next 6 months is a stagflationary environment. And in that environment, earnings estimates are going to fall. The question is how much. We've looked at when the GDP is more than 200 basis points below the inflation rate, which we think would be the best case scenario over the next 6 months. And in that environment, it's been a very poor earnings environment where you typically see earnings go negative year over year and the S&P 500 go negative year over year. And the big issue is the starting point around valuation. So we are still trading at 20 times earnings estimates that are not correct. And we have an equity risk premium that is still only 70 basis points. So if you think about what Waller said yesterday, tariffs are one of the biggest shocks in the U.S. in decades. And yet the equity risk premium is still only 70 basis points versus it being 300 basis points average over the last 20 years. So we think this makes it very tough.
Why do you think the S&P is still trading at 20 times? I mean, I think about, historically speaking, if you're concerned about something like a recession, you usually see an S&P that's trading at what, like 16 or 17 times. And even at 20 times, you're still pretty richly valued here. Why do you think you haven't seen a more meaningful downdraft yet? Is it just that everybody's waiting for earnings to come in?
So I think that's a great question. I mean, if you think back over the last 15 years, we haven't had a natural recession, right? We had COVID. It was, looking back in the scheme of history, it ended up being quite brief, that sell-off. So a lot of investors are accustomed to the fact that we don't get natural recessions. And then number two is we will get bailed out by the Fed and or the government. And so we always bounce. And I think that mindset is now embedded in the equity markets. Now, I'll say one other thing, which is that the companies today that represent the S&P 500 do deserve, keeping everything else equal, a higher multiple than, say, 20 years ago, to be fair. But having said that, this multiple we don't think is correct or pricing in any of the risks that are out there.
So if you don't invest in stocks right now at these levels, what do you invest in? Gold has been on a record tear, 33.50 we're at now. It's just been a monster.
Yeah, so I think you want to really be defensive right now, because I think if everything works out great and these tariff rates come down significantly, right, they're still going to be highly likely in place at a level that is still north of 10% on all imports. So even in that best case scenario, that's still going to be some sort of a shock to the economy. So while you're waiting, I think cash. I think the short end of the Treasury curve. I don't think you can go to the long end because we can talk about that, but all the risks that are involved there. And then I do think gold. And that's something that we've liked for a while, and we do think has some scarcity value in terms of finding a place of defense.
Quickly, Eric, why not the long end of the curve?
So very, unusual situation where you're going into an economic downturn, yet prices are going to be going up, and you're heading into the downturn with our deficit at $2.2 trillion. So in a downturn, that deficit is likely going to go up from an already very dangerous level. And lastly, because we have a situation where the rest of the world is going to be less inclined on margin to own U.S. assets.